I've been saying this for a while, is I think future expected growth is going lower, and that is what the bond market is picking up. The bond market had quite a strong day today, even though if you go to Google Trends and look at inflation, it's all-time record high mentions of inflation. The bond market still is nowhere near where it was back at peak in terms of yield. It rallied, the yields went up, came back down again. So it's fascinating that the bond market seems to suggest something different. The other thing that I've been talking about for a while was the propensity for the dollar to rally. That's played out in kind of big style over the last 3 weeks, where we saw a huge move, well, a relatively huge move in the dollar. And that's, again, I think, picking up on the weaker growth sentiment. It's not a yield sentiment because yields were higher earlier and the dollar wasn't higher then. It's to do with this, the fact that if you raise the price of food, gas, natural gas, and everything else on people, their propensity to spend goes down over time. So even though we're still seeing decent retail sales numbers, my guess is later we will see less. Now you've just added yet more COVID complications. You know, Europe, that doesn't look good right now. And Germany's talking about, do they do some partial lockdown, some full lockdown? I look at the chart of the Spanish stock market, it seems to be breaking lower. So there's something going on out there, but equity markets tend not to crack until the purchasing managers' indexes go, or indices go below 50 or head towards that level. So they're still relatively strong, they're coming off. So there should be no reason yet for the equity markets to really have any sort of shock, because the kind of things I'm talking about, the lower yield play and the higher dollar play and the slowing growth, are all stories for next year and not this year. Economies move like super tankers really, really slowly, but when they head in a direction, they're hard to stop. And the super tanker is turning, people just can't see it yet. That's my view. And the markets, the markets that are paid to listen, like the bond market, seems to be listening, as does the dollar. The University of Michigan surveys I've mentioned before, they break it down by spending category, like housing, cars, big ticket durable goods items. These are all-time record lows, the propensity to spend. And the reason being is they're overly expensive. That's what the survey comes back with, all-time record. So as always in financial markets, the rate of change that shocks people. And, you know, 2-year yields have increased massively. Then all of these costs have increased massively. So borrowing costs have risen, costs of buying stuff has risen, and everyone's going, you know what, I need to be careful. And if this sticks for a while longer, yeah, it's a problem.
Yeah, 2-year yields have quintupled from earlier in the year, trading at around 50 bips on a yield basis right now.
And people will laugh at you, say, you can't look at them in terms of percentage gains. It's simply not true, and I pointed this out in 2018 when we'd got the end of the kind of yield rise. People were like, you can't look at it in those terms. I said, it's the rate of change that matters. Because let's say you are a large corporate or family office or a bank, and you've refinanced money, you know, 1-year money at 25 basis points, and next minute it's trading at 100 basis points. That's a massive difference in your funding costs, because most people have taken on more leverage. So, yeah, I think it's a meaningful risk.
So, is the risk off trade here buy the stinking S&P? I mean, what's happening?
Yeah, it always is. Because don't forget, let's play through the scenario. So maybe I'm right. Maybe the economy starts to weaken. Maybe the ISM starts hitting 50. What happens next? The Fed print money and the S&P goes up because they've debased the denominator. So, yeah, we're in a different world here. It sounds ridiculous. Doesn't mean you can't get the sharp sell-off, the quick 20% sell-off over 2 weeks.
Right.
But if it's signifying anything to do with the economy, anything more than that, and the Fed's in again, saying, well, you know, they're going to calm the markets, and then if they see economic growth slowing down, they're going to stimulate again.
Yeah. By the way,
that's their trick, right?
More hawkish talk from the Fed today, which, you know, maybe means this sort of counter indicator, precisely what you say.
That's right. And if the hawkish talk from the Fed mean that bond yields start falling. I understand the yield curve, though 2 years have been going up, but generally it's telling us that the forward expectations of inflation are going to fall over time. I always say I listen to the bond market and I'm listening intently. Again, this is not a story for now. This is a story that we're seeing slowly, like a snowball at the top of a hill, rolling down, picking up, more gravitas as it goes. We've got a big issue to overcome, and these headwinds just add into that story for next year. If you're thinking about it, you put a whiteboard up and you start stacking up all of these things. I don't see the growth story. The side on the growth story of the whiteboard is looking pretty scant right now. And that's what people have to realize. They can't just look at the inflation now or the supply chain and say it's all due to demand. It's mainly due to supply, hence why it's called supply chain. That issue has actually caused a slowdown in growth, which has always been my point. It's always why the bond yields come down in the chart of truth channel, is you cannot raise rates or generate inflation in this economy because it kills growth every time. Reason being, it's overly indebted. If you raise inflation on overly indebted people, they can't pay their debts. So what happens is things slow down, they spend less. It's really not that complicated.
Yeah, 8.6 trillion still on the Fed balance sheet, though the taper has reduced $120 billion in monthly purchases of Treasury debt and agency securities by $15 billion. Obviously, the balance sheet remains incredibly expanded, to your point about indebtedness.
Yeah, and the rate of change of the balance sheet is still positive, but it will start to slow down. And again, once you get to zero, it's basically once the rate of balance sheet growth goes to zero of most of the major nations, then you can start to see equities correct because you've got fiscal stimulus that's gone. You'll see the business cycle turn lower. It happens almost every time. So, and then usually what happens, particularly after these recession periods, you get a period where the growth slows down, we get more stimulus, it picks up again, it slows down, we get more stimulus, and then eventually it finds some sort of traction level. Whatever the new trend rate of growth for the world is, we have no idea right now. It is not going to be clear for another 2 years what the hell kind of growth we've got. Is it what some people think, we've got a new rate of growth that's higher because of stimulus and other stuff, and it's, the US is 3%? Or is the trend rate of growth what I think it's going to be that the demographics suggest, which is provable with demographic charts, that it's 1% or less? That's the issue here. The issue is people talk about wage growth as well. You need to offset that with the number of people leaving the wage force, the labor force, because the net pool of wages may be increasing on those guys, but there's so many people leaving here that are now not getting an income. I was like, wow. So there is a structural change in the labor force and what people will do for a living and what they won't currently.